sometimes the reasons why don't matter. If you're long something that goes up, you make the same amount of dollars, whether it's blind luck, whether because you had it nailed on a fundamental reason. Of course, the problem with that is if it's blind luck, you start to believe your own BS and you think you're sort of bulletproof. And I think that's the phase we are right now in the stock market. Blind luck is turned into I'm a genius, and typically I'm a genius is toward the end of the cycle. So I think that's where we are now.
Welcome to the Risk Reversal Podcast. I'm Nathan, joined by Guy Adami on a Monday edition of the RRP Guy.
Final Monday in the month of July. It is remarkable how quickly things pass us by.
Like that. This is a busy week on the Risk Reversal Podcast and Market Call, so tune in for all of that this week. But we have 40% of the S&P 500 reporting this week, guys. Some of the biggest names in the Mag 7. We have a Fed meeting on Wednesday. We have GDP. We have the all-important jobs report on Friday. We have the Fed's most favored inflation.
That's the PCE.
That would be the PCE. So a lot of stuff to go through here. Let's start with EU trade deal announced yesterday. 15% tariffs imposed on most imports here to the U.S. I think there was a Wall Street Journal article that I found most interesting. Companies welcome EU-U.S. trade deal as least bad outcome, right? So we talk about the certainty here, 15% tariffs. You know, let's be clear, those tariffs on these goods that were coming in last year were low single digits, that sort of thing. So the clarity that a lot of these companies have is great. We've done some math. Peter Bookvar, Bleakley Advisors, has done the math. If we have a blended rate, like let's say across most of these countries, between 15 and 20% or something like that, that's going to be a huge drag to global growth. I think that's one of the things that, when I say huge, like maybe a percentage point or something like that, depending upon where those differentials are. Thoughts here, Guy, because this is another one with a framework. Last week, this time, we had a Japanese framework. We also had commitments for those countries to invest, let's say, $500 billion into the U.S. Those are the things that I think are most cloudy.
I think what we've learned, if we've learned anything, is you lead with the worst possible scenario, understanding that in terms of what you're asking for, you're not going to get it, and hoping to get somewhere between the starting point, what you led with, and somewhere in the middle is where things sort of shake out. And I think that's what we're seeing here. And what I'm always fascinated by is the ability to create a problem that may or may not be there, then solve said problem in a really loud and boisterous fashion, if for lack of a better term. So that's what we're seeing now. But I also think to a certain extent, the market might be picking up on this a bit as well. You seemingly have diminishing marginal returns in terms of what we're seeing market reaction wise. And, you know, maybe the market's been sort of, I don't know, desensitized to the entire thing. And I think that's what we're seeing now. I mean, I guess the certainty of a trade deal is a good thing. I just think it gets this off the back burner and puts it sort of, you know, front and center. China is next. That will probably get done in the foreseeable future. And it'll be interesting to see how the market reacts to that one, because that's probably the final piece of this entire puzzle.
Yeah. And once we have frameworks and, you know, we have the certainty of 15%, 20%, whatever the heck it ends up being, who the exemptions are, you know, Axios had a good piece this morning. Tariff revenue is spiking, but who is exactly is paying? The government generated an extra $20 billion for each of the last 2 months, which could total $240 billion. And so they go on to just kind of discuss that, yeah, there's the exporters, there's the importers, there's the consumers, you know, depending upon what industry you are and what sort of purchasing power or leverage that you have over those exporters, you know, whether it's in retail, whether it's a Walmart. You know, we learned last week from the autos, they're getting killed. I mean, if you look at GM and Stellantis and that sort of thing. And so if you say to yourself, well, that was just the first quarter of these sorts of tariffs, and now they're expecting 15% or so, somebody's got to eat that, right? And some of the companies that are in weaker sort of industries, like auto demand was already starting to weaken. You know, the housing market is in a tough spot right here. So the higher input costs and the higher labor costs and, you know, all those sorts of things. I mean, these are really important parts of our economy that are probably not that well suited to eat higher costs right now.
You know, I think there's a misconception out there that somehow these things are magically paid for. But as you've pointed out, and I think it's important to say again, somebody's paying for these things. Again, whether it's the manufacturers eating it, whether it's passing it on to consumer or some combination of the two, it's getting passed on somehow. And I think the point you've been making is there are no free lunches here. And at a certain point, it does become a bit of a headwind for growth. And, I think the market is, for whatever reason, is looking past that. But recently, in terms of these announcements, maybe not so much. And it does come down to, at a certain point, these are out of the way. What does it mean? What does it mean in terms of growth? What does it mean for the potential for interest rates to continue to sort of grind higher? And what does it mean, if anything, for valuations, which continue to be extended? Now, we had a conversation with Dan Greenhouse last week. He pointed out, again, as we've said many times, valuations don't matter until they do. But what I also pointed out was, with each passing day, there's less and less cushion, there's less and less protection on the downside in the form of reasonable valuations.
Yeah, and we're going to get to that. There was an interesting article in the Wall Street Journal just talking about signs of a bubble. And I think you and I would both agree is like, the sort of enthusiasm we're seeing in the markets right here, I don't think is really reflective of some of the kind of mayhem that we saw to the upside in 2021, or going back to, let's say, the dot-com sort of thing. And you could say, well, history's rhyming a little bit. And sure it is. It's just a different market here, and there's just different dynamics. And, we've talked a lot about this retail investor and how they kind of play a huge role in this sort of market environment. Very different, I'd say, than 25 years ago. One of the things, Guy, that struck me about this trade deal, and it was also the sort of thing that we saw in Japan, it's just like there are lots of demographics or lots of interests in these countries. Now, obviously, the EU is a bloc, but, the Germans are not happy about this deal. The French are not happy about this deal. There's a lot of folks in Japan who are not happy about the deal last week. And you could say, well, they don't have much of a choice. But if you think about the fact that we've gone out there with a big stick and we've just been bullying first all of our allies, it doesn't seem like Canada is any closer to coming to the table. I don't know about Mexico. But at the end of the day, if you have frameworks, if you have these sorts of commitments that if you're a country, you can't make your companies buy energy from the U.S. You can't make them buy automobiles. We've talked about, a lot of these kind of, not developed countries, that they did a bunch of deals with in the beginning. We don't even have, these huge trade deficits, right? But they can't afford our stuff anyway, and we rely on them for cheap manufacturing, especially as we're diversifying away from China. So these are the sorts of things, we can wrap this into some geopolitical sort of stuff, is like we are becoming a less reliable partner to a lot of the allies first and foremost. And then obviously if we know, or if our adversaries know we are likely to back down, you just said it, you start with some extreme number, right? And then you work your way back. And it'll be interesting to see how long a Chinese deal gets pushed out and ultimately what we get, because we've made this point again and again. The first tariffs we put on China in the first Trump administration was in March of 2018, and we did not really have a framework for a phase one deal until January of 2020.
You lead with these great headlines. The investments are going to be made in the United States, the amount of things these different countries are going to buy from the United States, and the numbers are staggering. But, 6, 9, 12 months later, does anybody really do the work necessary to find out if, in fact, this is taking place? And my instincts suggest it's not. It's one of those things, if somebody nags you long enough, you promise them something just to get them off your back. And whether or not it comes to fruition or not is almost sort of secondary. It's the headline that everybody grabs onto. The aftermath, people don't really pay as much attention to. And, I don't know what our adversaries are looking at. And, I don't know exactly what's going to happen with China. What I will tell you, though, is, the market, I think, is starting to get, as the word I used before, sort of desensitized to all this. And at a certain point, it's going to come back down to what are we looking like in terms of a slowdown, a reacceleration? What are we looking like in terms of valuations, which, again, are stretched? And, what is on the burner in terms of the reacceleration of growth here in the United States? Because quite frankly, I don't see it. And you've talked about this. I do think there's an importance to the home ownership part of the economy, the home builders per se. We're looking at inventories now that are approximately at 10 months of worth of inventories, which is the 6 times it's happened over the last, I think, 60 or 70 years. 5 of them have led to a recession in terms of that indicator. So there are a lot of things that continue to sort of flash red.
Yeah, the one thing, and we talked about this a little bit, guys. So when you talk about China and you're trying to figure out kind of like who has the leverage, about a month, 6 weeks ago, there was a lot of talk about rare earth materials, our dependence on them for a whole host of different things that are very crucial to our economy, not just the domestic, corporate economy or whatever you want to call it, but also our defense infrastructure and the like. And it seems like there was two reasons why the Trump administration lifted these export bans of these Nvidia GPUs to China. Now, granted, these were changed. They were scaled down versions of them, but it turned out to be like this is rare earths versus high-end GPUs. And Jensen Huang, the CEO of Nvidia, did a heck of a job. He really actually he rooked the White House here on this one. I mean, he went in there and did a job. There was a great New York Times daily podcast about this last week. And, at the end of the day, Nvidia took a $5.5 billion charge against lost sales, that they had to China. I think it was in Q1. And here they are now, they're making the case that these chips are not that important. They don't want to cede AI supremacy to the Chinese, let them kind of, innovate on their own. But yet these chips are much better than anything the Chinese have right now. And make no mistake about it, they're helping to power their large language models and other kind of technology in and around generative AI, but they're also going to work themselves into their defense apparatus. So the idea that we have, a corporate overlord of this entire AI sort of build out over the last few years, which has had hundreds of billions of dollars in revenue by selling these chips, right? And a lot of that has come from China. Now they are willing to kind of, overlook those sorts of what I would say are national security concerns for profits there. Now, he has a fiduciary responsibility, but the fact of the matter is the Trump administration first saw this sort of issue, right? And then they kind of changed their mind based on the sort of deals that they could do. Remember, Jensen went to Saudi Arabia and UAE and all that sort of stuff. So to me, I think this is a huge issue. I know there's a lot of folks that are very focused on it. I know there's a lot of security folks that were in the first administration that signed, I think, an open letter about this very issue, that we should not be doing this. But I think this is the sort of thing that there needs to be more light shed on.
And, what they will say is in every deal, there's compromise, and the compromise here was to give the scaled down version, understanding that if they didn't do it, that would open up potential the Chinese sort of create on their own. So maybe by doing this, you sort of thwart their ability to innovate or whatever it is. So I think there is a level of compromise here. Some people say the Trump administration did the right thing. I don't really have a view. What I will tell you, though, is Nvidia continues to sort of play both sides of the fence extraordinarily well, as you said.
Yeah, and again, I mean, it's just like this is not exactly an America First policy. It is the only point. I mean, just seems to be a lot of inconsistencies there. And I just think that the most highly valued company on the planet, that would be Nvidia, with over a $4 trillion market cap. The idea that they're going to take a $5.5 billion charge because they can't sell, their high-end technology to our biggest adversary. This is going to be the one. This is the main event for the trade war. I just think it doesn't speak that well about Jensen's intents, but that's my view. All right, here's one. This is going to be near and dear to your heart. This is Wall Street Journal today. We're talking about a refunding announcement by the Treasury. You're going to love this. Treasury Secretary Bessent, he's calling himself the nation's top bond salesman guy. They've suggested that because they're waiting for lower interest rates, they're going to actually issue longer term debt once rates come down a little bit. Thoughts here, because this is one, I know that you often say careful what you wish for. The idea of trying to time this sort of activity when it meant to be a very take it to the bank sort of schedule in which to do this sort of stuff could be kind of difficult when you're dealing with a market that is infinitely bigger than the stock market, but also has global implications, as far as what rates are and what sort of debt issuance there is.
This is a high stakes game. I mean, Janet Yellen played the same game, by the way. Funding with bills instead of going longer out. By the way, she had the opportunity, I think, at a certain point to do some longer duration things. Gary Cohn, when he was in the administration, pushed for a 50-year bond, a 100-year bond. For whatever reason, that sort of fell on deaf ears. And a number of people have tried to explain it to me. It's sort of upsetting the traditional apple cart. But in retrospect, given the timing of the entire thing, it would have been a really prescient and smart move. But what he's basically saying is, I think interest rates are going to come down. There's no reason to issue longer term debt at current rates. And I'll play the short game with the hopes that in 6 or 9 months or whatever it is, rates will come down where we can start to issue on the longer end of the curve. The problem with that, of course, is it's exactly that, a high stakes game of poker. And at a certain point, I do believe the market's going to start to call a little bit of BS in the form of longer dated bonds. So yeah, there's a real, listen, again, the Fed could lower rates. Jerome Powell could acquiesce, or the data could change and they start to do things that the market doesn't expect. But I will tell you categorically, that doesn't mean the back end of the curve is going to sort of act in kind. And I think therein lies the problem. So, and on paper, it makes a lot of sense. We know rates are coming down. So why issue debt at longer term when we know 6 months from now they're going to be lower? That makes sense in terms of pen and paper. I don't think it makes sense in practice.
Yeah, Guy, I've known you for about 15 years. You and I have done hundreds of podcasts together, hundreds of Fast Moneys together. I think I could make a guess that your most formative years in your illustrious 30-plus year career were probably that of your time at Goldman Sachs. Is that fair to say a little bit?
Goldman Sachs was, I think it was there about almost 8 years. It was an extraordinary period of time. Yeah, and the people that I met there and the things that I learned there absolutely were formative. And that was, I think I joined Goldman 10 years into my career already. So yes is the short answer.
Well, it's funny. You just mentioned Gary Cohn. I know that you guys are close. You worked for him for a while. You guys have like a ton of respect for each other. I know Harvey Schwartz. He was one of the big shots over there for a while. There's just an article about him. He's the CEO of Carlyle and the FT this morning. Guy, I forwarded it to you. You'll be happy to see that. But another gentleman who is the CEO of Goldman Sachs, who you and I are both a big fan of. We had the opportunity at a CME event a couple years ago to interview him. And, David Solomon sounds oftentimes more like a tech CEO than the CEO of a major investment bank. And, he was on the Master Investor podcast with our good friend Wilfred Frost. I think that dropped late last week. You can find it in your favorite podcast store. Go follow it, rate it, review it. That's how people find it. He's also on the YouTube. But Solomon had some words that are not too dissimilar than things that I've heard you say about debt deficits and the like, and what that might mean for the future. Jacob, play the clip, please.
We're growing our debt in the United States. The debt levels are growing. We're trying to run, or this administration is certainly trying to run, a higher growth play. If we can't get growth to accelerate from here, to deal with the fact that we're spending more and we're growing the debt level, over time, rates gradually will creep up because the debt stack will grow. In rough numbers, we have $37 trillion of debt in the U.S. As we're refinancing the current stack at higher rates than it's currently financed, we're growing it through the rest of the decade into the 40s. Mm-hmm. And if we continue to spend, you're growing it higher. So ultimately, the question is, at what price, if you want to have term treasury rates to finance that debt and not finance it all short against the policy rate, at what price do you have to raise, or will investors demand, to finance that term debt? And I think over time, the pressure is going to be on higher term rates. And that's going to be a secular change. And that will create pressure on growth and, other fiscal issues over time.
Sounds like something we've been saying for a while. I mean, he says it far more eloquently than I, but it's basically the same thing. Debt levels are unsustainable. You're talking about $38 trillion of debt sitting on a GDP of, let's call it 27, maybe 28. I think the hope is you'll grow your way out of that hole. I don't think that it happens. I think more likely is that 128% or so, wherever we're currently trading of debt to GDP, continues to expand. And as Mr. Solomon said, the market's it's not that the market's not going to buy your longer dated debt. It's the market's going to demand a higher rate of interest to do so, which is something we've been saying for quite some time. And I will tell you that I don't believe the stock market is positioned for that at all.
All right, so let's talk about a stock market that's nearly 6,400. It's up nearly 9% of the year. That's the S&P 500. We have a VIX at like 15.5. We have a 10-year U.S. Treasury yield that's just stuck here at 0.41. You could say, well, maybe that's not a horrible thing, especially as we kind of wait and see some of the data that we have this week and what the Fed kind of tenor is and what sort of dissent that we see. I guess there's expectations for 2 dissents with a no cut at this meeting, Guy, and that has not happened in over 30 years. We have a U.S. dollar that has not moved a whole heck of a lot from those lows in April and is flirting, with like 5-year lows. And so you got to focus on, what the sentiment is right here. And it seems nearly euphoric. We're going to talk about some signs in the Wall Street Journal article talking about bubble, but I want to hit Mike Wilson. He's our good friend and head strategist over at Morgan Stanley because, in his note this morning, he had a few interesting things to say, guys. So he's calling this market cycle no ordinary cycle. We have a rolling recovery underway, prompting a shift toward a 12-month S&P 500 bull case target of 7,200. Again, we're at 6,400. Mike has done a very nice job from a transparency standpoint on our podcast once a quarter over the last few years or so. He knows that he got a lot of stuff wrong in 2023 into 2024. He was very clear about what those things were. He changed his tune, I want to say nearly, Guy, maybe 9 months ago, maybe even a year ago. Here's what he's saying that gets him to his bull case. The key drivers: positive operating leverage, AI adoption, dollar weakness, cash tax savings, easy growth comparisons, pent-up demand, and expected Fed funds rate cuts. Industrials is the sector he's like, I don't know, man, 7,200 at this point, his bull case target, we're at 6,400. We're already up 9% of the year. It seems like a lot of folks are kind of pricing in the potential for that sort of 1995 to 1999 move in the S&P 500, where we average 25% gains a year for those 5 years.
So what is that? Another 8% or so from here, back of the envelope in terms of the S&P. Could it happen? Listen, what I will say. I've been around long enough and I've seen enough market moves to suggest that, there's an absolute chance that it happens. And it's not going to be on the basis, in my opinion, of fundamentals. It's going to be more, I think, on the basis of just this wild chase and people's continuability or willingness to buy the market at higher and higher valuations. Because personally, I don't think the fundamentals warrant it at all. But, could we see 7,200? Yeah. Do I think we're going to see it? Absolutely not. And, the number of different metrics we look at continue to sort of flash red. Not that anybody seems to care, but there's a reason why Berkshire Hathaway has $340 billion of cash sitting on their balance sheet. That is $1 trillion company, by the way, so you can do that math. There's also a reason why nobody seems to be caring about the CAPE ratio, the cyclically adjusted price to earnings ratio, which is at the second highest reading, I think, in history since they started looking at those things. Again, something that nobody seems to care about. And again, just to mention Dan Greenhouse, who talked to last week, valuations matter when they do. When things are going great, people look past them. When things start to go a little pear-shaped, the first thing people will look at are valuations, and you have zero valuation cushion in this market, in my opinion.
Yeah, and I guess that's the main point. You put that together with a bunch of other activity. You see market participants broadening out the rally into far less high quality sort of stocks. We had some data last week, I think it was from FactSet, talking about the performance of Russell 3000. What percent of non-profitable stocks? They were up like 36% relative, to a lot of other names in that index that are profitable. You're also seeing, crypto stuff going on. You're seeing meme stocks. It seems like there's a new couple every day. But I guess here's one of the most important ones, and our friend Doug Cass points this out all the time: the equity risk premium, defined as the gap between the S&P 500's projected earnings yield and the yield on the 10-year U.S. Treasury. It's close to zero. It has not been close to zero in 20 years. And those are the sorts of things that you probably want to pay attention of. And, right now you could say, okay, that's all fine. The economy is just fine. Interest rates are going to come lower. We're going to get the kind of tailwind of tax cuts. The trade deals are sorting out, and we're going to have some certainty on that. And listen, it's not to call it's not like we're saying like the market's going to implode here, but the fact that we're up nearly 30% off those April lows, and I don't think we're in that much of a better position. If anything, we're in a weaker economic position both here and abroad, and sooner or later that should come to bear, I think, at least on stock market valuations.
But you need a catalyst for that. And I agree with everything you just said, but what will be the catalyst? Like, what will be the trigger? In the same way we saw a trigger back in April, in the same way we saw a trigger back in August of last year, certain headline events were the reasons given or the catalyst for And that's what we sort of have to try to figure out, because right now, as you sort of look at the landscape and as we approach August, there's really no catalyst on the horizon. But typically when there's no catalyst on the horizon, that's when something comes seemingly out of nowhere. So look, all the concerns that I've had, unfounded as they may be, through a lens of an S&P that just made an all-time high today, are still there. They have not gone away.
Right. So if we just think about Fed Chair Powell on Wednesday, his presser maybe is a bit more hawkish. Maybe that is one of the sort of catalysts. If you look at Friday morning, we have the July jobs number. Let's just say that's a little hot, right? That would be the thing to keep the Fed at bay. And then the last thing, let's just hit earnings really quickly. So we know that, again, like I said, we have 40% of the S&P 500 reporting on Wednesday. We have Meta and we have Microsoft. I think those are two names in the Mag 7 that folks are most optimistic about after Google's results last week. I would say the bar is kind of high on that front. Amazon and Apple on Thursday, those are two names that are probably most likely adversely affected by tariffs going forward. But in the meantime, you probably saw a pull forward, right, for both of them from a retail standpoint, which kind of suggests that the quarters are probably going to be just fine. It really is about the guidance. But the last thing I'll just say on earnings, Guy, last week, and we hit this a bit on the pods and on Fast Money, is that a lot of the reactions to beats and even in some instances raise, it started with Netflix. Netflix has barely seen an uptick since they reported about a week and a half ago. I'd say Google, its response was very tepid, right? I mean, I think it initially gapped up 4 or 5%, closed up on the day about 1%, and really hasn't gone anywhere. Since then, we had Texas Instruments, IBM, Intel. I think I'm missing a couple others that really took it on the chin.
ASML. Yeah, there have been a few.
Yeah, so there's been a lot. I mean, even there was one, ServiceNow, which actually gapped up 7-8%. Okay, this was, I think, on Thursday morning, filled in the entire gap over Thursday and Friday. So that was one where it appeared to be a beat and raise, but investors weren't having any of it. So Microsoft, Meta, Apple, Amazon, I mean, listen, they could all go different ways. They cancel each other out, and the likelihood of them any one of them dropping a bomb is not particularly great. But what's most interesting to me is see if they are good quarters and the guidance is good enough, how the stocks react afterward.
It's about the reaction. It's exactly right. And your point about all those stocks are spot on. I will tell you, out of all the ones you just mentioned, the lack of performance in Google is disheartening in a word. I thought that quarter, especially the fact that search was a surprise to the upside and it should have sort of assuaged some of the concerns that people had, was going to be enough to get it to that sort of 207 level, which I believe was at the all-time high we saw February-ish of this year. Obviously, that hasn't happened yet. And I will tell you, and I know you know this, the head and shoulders formation that has been formed is still intact. So you really need this thing, Google, to start to perform in a pretty meaningful way. If we start to slide, you get a close below 190, then things start to look dicey. Forget about the fundamentals, just on a technical level.
Yeah, and the last group that, they got the earnings season kicked off, it was the banks. The outperformance there has been, it's been very impressive. Let's be very clear about that. And so, that's one sector you can say it's very important from an economic standpoint. It's very important from a market sentiment standpoint. What they had to say about the consumer, both, fairly broadly, I think was something that was worth paying attention to for some of those who are just out there looking to pick holes in it, which I think I would say myself, I'm trying to do a little bit here, because the sentiment that's out there in the market, it doesn't seem euphoric yet, but just to your point earlier, it seems like that market participants are ignoring a whole heck of a lot, Guy Adami.
I agree. But again, they've been right to ignore a whole heck of a lot. That's sort of what we're up against. As you know, and as I've tried to point out, sometimes the reasons why don't matter. If you're long something that goes up, you make the same amount of dollars, whether it's blind luck, whether because you had it nailed on a fundamental reason. Of course, the problem with that is if it's blind luck, you start to believe your own BS and you think you're sort of bulletproof. And I think that's the phase we are right now in the stock market. Blind luck is turned into I'm a genius, and typically I'm a genius is toward the end of a cycle. So I think that's where we are now.
All right, this is the end of the podcast. Thanks for being here, everybody. You can check us out all week at the RiskReversal Podcast. We will be doing Market Call, 11 a.m. Eastern, Monday, Tuesday, Wednesday, Thursday. Thanks for being here.